We all tend to focus on a company's profit, right? That big headline number. But what if I told you that number is really just the beginning of the story? Today, we're going to grab our magnifying glasses and dig into the financial footnotes, because that's where you find the secrets that tell you what's really going on with a company's health.
So let me ask you this. Is a profitable company always a good investment? I mean, the obvious answer seems to be yes, doesn't it? But it's not always that simple. In fact, sometimes that shiny profit figure can actually be hiding some pretty big problems.
So where's the real story? Well, it's often tucked away in the one place most people just skip right over, the financial footnotes. And today, we're going to show you exactly what to look for in that fine print.
All right, first up on our investigation, let's talk about the ownership story. We're going to follow the money trail, and we'll find it in a document called the Statement of Changes in Stockholders' Equity. It's a bit of a mouthful, but it basically tracks how the value of the owner's stake in the company has changed over time.
So what exactly is stockholders' equity? Let's make it simple. Imagine a company sells every single thing it owns, its buildings, its computers, everything, and uses that cash to pay off all its debts. Whatever money is left over, that's the stockholders' equity. It's what the owners truly own, free and clear.
Now, this statement might look like just another boring table of numbers, but trust me, it's not. It really is a story. It connects all the dots, taking you from the value of the owner's stake at the start of the year all the way to the end, showing every little twist and turn along the way.
Okay, let's zoom in on a really key part of this statement: retained earnings. This is basically the grand total of all the profits a company has decided to keep in the business over its entire lifetime. The math here is super simple. You start with whatever you had at the beginning of the year, you add the profit, the net income from this year, and you subtract any dividends paid out to the owners.
So, when a company's profitable, that net income gets added to the retained earnings. Think of it like pouring more money into the owner's pot. This increases their equity and means those profits are being reinvested right back into the business to help it grow.
But what about when the company decides to share some of that profit with its shareholders? Well, that's a dividend. Dividends are paid out from those retained earnings. It's a great way to reward investors for sure, but it also means there's less cash left in the company for reinvestment and future growth.
And this brings us to a really crucial question. We keep talking about net income, but where does that number even come from? It's not just a simple objective fact. It's actually shaped by a whole series of accounting choices the company makes. So, who's making those calls, and how do they do it?
To find out, we need to head to our next section. We've got to read the fine print. Welcome to the notes to the financial statements. You can think of this as the company's official rulebook, explaining all the methods they use to get to the numbers.
And I mean, it says it right there in black and white. The whole purpose of the notes is to explain what's going on in the main statements. They're not just some optional extra reading, they're absolutely essential if you want to understand the full picture. They give context, they give clarity, and they can even signal potential risks.
So here's a pro tip for you. If you only have time to read one thing in the entire annual report, read the very first note. This is where the company lays all its cards on the table and tells you exactly which accounting rules and methods it has chosen to play by.
And you'd probably be surprised by just how many judgment calls a company has to make. We're talking about really important stuff here. How quickly do they write off the value of their equipment? How do they value the stuff sitting in their warehouse? At what exact moment do they say they've earned revenue? Every single one of these choices can dramatically change that final net income number.
And this is where you can really start to see a company's personality. Are they using liberal or aggressive policies that make their current income look as high as possible? For example, saying a new machine will last for 20 years instead of 10 makes today's profits look bigger. Or are they taking a more conservative approach, which might mean lower profits today but signals they're building for the long term? The choices they make here tell you a lot about management's priorities.
But even after we've dug through all of this, it's really important to remember that financial statements have their limits. They're an incredibly powerful tool, don't get me wrong, but they just don't tell the whole story.
Yeah, financial statements can't capture everything. They can't put a dollar value on things like a fantastic brand reputation or amazing employee morale. And remember, they are built on estimates and they use historical costs, what something was worth when it was bought, not what it's worth today. Plus, they tell you nothing about what the competition is up to.
And underneath this entire system is one massive critical assumption, that the company is a going concern. It's all based on the belief that the business will still be around to operate tomorrow and the day after that.
If that assumption turns out to be wrong, if the company is actually heading for bankruptcy, then honestly, all these numbers mean something completely different.
So, what's the big takeaway here? Well, you now have the tools you need to look beyond the headlines and become a much smarter investor. You've got to start thinking of yourself as a financial detective.
And every good detective needs a toolkit, so here's yours. It's just 3 simple steps. 1. Trace the ownership story in that statement of stockholders' equity. 2. Read the company's rulebook in that all-important first note. And 3. Always ask yourself, what are these numbers not telling me?
So there you have it. You now have the keys to look beyond the surface and understand the real story behind the numbers. The only question left is, the next time you look at a financial report, what hidden details are you going to uncover?